The Nasdaq market is now closed, with Plug Power Inc. (PLUG) finishing the session on Friday, October 17, 2025, at a closing price of $3.40 per share. This represents a decline of -2.15% from the previous close, trading in an intraday range of $3.38 to $3.59. The official closing price of $3.40, while a slight dip, actually masks a significant underlying momentum shift that occurred earlier in the month, a shift most retail investors are still digesting. While the market chatter this past week has focused on the stock cooling off after a major surge, the reality that matters is the surprising level of institutional buy-ins seen during that run-up, exemplified by a major warrant exercise that brought in approximately $370 million in gross proceeds in March 2025, a crucial liquidity injection that most investors missed when they were only focusing on daily volatility. This institutional confidence, despite the persistent losses, suggests that sophisticated investors are looking past the short-term financials and placing large bets on the company's ability to execute its long-term plan, a clear contrast between the market's expectation of near-term cash concerns and the actual financial maneuvers that have provided a substantial buffer. The prevailing market narrative around Plug Power, particularly after its dramatic run-up from a 52-week low of 69 cents to a recent high of $4.58, is one of extreme volatility, a high-risk, high-reward bet on the volatile hydrogen sector. This narrative is not entirely wrong. The stock is notoriously volatile, driven by sentiment and headline news. However, this common belief fails to recognize the mechanical drivers of the recent price action and the fundamental business moves that have been de-risking the liquidity profile. The sharp upward move earlier in October was not just retail hype, it was fundamentally fueled by a major analyst upgrade from H.C. Wainwright & Co., which raised its price target from $3 to an optimistic $7 following a major hydrogen deal update, specifically the delivery of a 10-megawatt GenEco electrolyzer array to Galp, a Portuguese energy firm. This upgrade and the large European project provided validation for the company's technology and international expansion strategy, causing the stock to soar over 37% in a single session on October 3rd. That rapid appreciation, coupled with a persistently high short interest that often exceeds 30% of the tradable float, created an accelerated positive feedback loop, forcing short sellers to cover their positions and driving the price up further in a classic short squeeze dynamic. The subsequent retreat this past week, including Friday's modest decline, is simply a natural unwinding of that extreme short-term speculation, bringing the stock back closer to what analysts like TD Cowen see as a more realistic near-term target of $4.50. It's important to understand the recent price behavior not as a failure of the narrative, but as a battle between true conviction buyers who see the long-term value of hydrogen infrastructure and short-term traders reacting to technical levels and news flow. The true underlying reality here is the slow, steady progress in securing non-dilutive financing and hitting large-scale production milestones. Examining the institutional landscape reinforces this deeper reality. While retail investors own a significant portion of the stock, major institutions have been actively repositioning. According to recent institutional ownership data, institutions collectively own approximately 41% of the company's shares. A key point is the change in institutional holdings leading up to the most volatile periods. BlackRock Inc. increased its stake by over 61% in a filing dated July 2025, suggesting a fundamental belief in the company's trajectory even before the recent price surges. While other large holders like Vanguard and State Street showed smaller movements, the directional flow of smart money suggests accumulation, or at least a firm holding pattern during a time when market noise was dominated by solvency fears. This institutional vote of confidence is not a guarantee of future returns, but it certainly challenges the common retail fear that the company is on the brink of collapse. The liquidity concerns, which have always been the bear's most compelling argument, were directly addressed in May 2025 with the securing of a $525 million secured credit facility. This action, combined with the warrant exercise, provided a much-needed capital injection that management is using to execute their Project Quantum Leap cost reduction initiative, which is targeting over $200 million in annualized savings. The goal is clear. Transition from a capital-intensive builder of infrastructure to a company with positive gross margins, a key milestone management is aiming to achieve by the end of 2025. The core business model of Plug Power focuses on building a vertically integrated green hydrogen ecosystem. This means they are involved in everything from the production of hydrogen fuel using electrolyzers, hence the significance of the Galp and Georgia plant updates, to the manufacturing of fuel cells and the operation of a distribution network with fueling stations. Historically, the company has found its biggest market in material handling, providing hydrogen-powered forklifts and related infrastructure to large clients like Amazon and Walmart, a stable, growing source of revenue. The problem has always been the immense upfront cost and energy consumption required to scale this network, leading to persistent negative gross margins and significant cash burn, a reality that has frustrated investors for years. Plug Power's latest quarterly results from Q1 2025 actually showed an improving trend, with revenue climbing to $137.7 million, up from $120.3 million the prior year. More importantly, the gross margin loss dramatically improved to -55% from -132% year-over-year. This progress, while still demonstrating a loss, is the tangible evidence of the cost controls and pricing adjustments beginning to take hold. For the stock to stabilize and reward long-term holders, this trend must continue aggressively. Comment below how you balance the promise of hydrogen technology with the company's sustained financial losses. Looking ahead to the next 12 to 18 months, the future outlook for Plug Power hinges almost entirely on two critical points: continued operational execution and favorable macroeconomic and policy tailwinds. On the execution front, the market will be hyper-focused on Q3 and Q4 2025 earnings reports. Investors need to see tangible results from Project Quantum Leap, specifically a clear path or even the achievement of that positive gross margin target. The company's electrolyzer business is expected to be a major growth driver, particularly with the global push for decarbonization and the increasing competitiveness of green hydrogen versus fossil fuels, a trend cited by analysts in their bullish calls. However, there are significant risks that could derail this optimistic scenario. Continued high cash burn, which was over $600 million in the last 12 months, remains a major concern, as does the potential for further shareholder dilution if the company needs to raise more equity. The hydrogen market is highly dependent on government incentives and clear regulatory frameworks, and any delay or change in the application of tax credits or subsidies could severely impact the economics of their projects. For instance, the demand for hydrogen to power the growing needs of the AI and data center sectors, a newly emerging narrative, presents a massive opportunity, but it's still highly speculative. Plug Power is positioning itself to capitalize on this, but the actual revenue from that segment remains to be proven. The current price of $340 sits in a precarious position, well above the consensus analyst price target of $229, which reflects a heavily skeptical view from the broader analyst community, but far below the most optimistic targets of $7. This wide divergence is the ultimate expression of the tension between expectation and reality. The expectation is that one new deal or policy shift will send the stock soaring. The reality is that the next year will be a difficult grind of cost-cutting and slow incremental margin improvement. The authority on this stock isn't in believing the higher low price target, but in recognizing that the stock's performance is tied to the successful management of its operational expenses and the steady build-out of its infrastructure, a slow and steady reality that contrasts sharply with the quick-win expectations of most investors. The path to sustained success for Plug Power is not a sudden sprint, but a marathon of meticulous financial control and production scaling, and investors who fail to appreciate this operational realism are likely to be left scratching their heads during the inevitable periods of volatility. In summary, the stock closed Friday at $340, a dip that tells only the fraction of the story. The popular expectation of pure hydrogen speculation driving the price is insufficient. The deeper reality reveals a calculated effort by management to secure liquidity through warrant exercises and debt facilities, addressing solvency concerns while systematically working towards a crucial positive gross margin target through an aggressive cost reduction plan. The institutional accumulation during recent volatility signals a belief in the long-term project, even as the company continues to post losses. Future performance is a direct function of operational execution, hitting gross margin goals and scaling electrolyzer deliveries, and managing the inherent financial risk associated with the capital intensity of the green energy sector. Understanding Plug Power requires moving past the daily price swings and focusing on the underlying engineering and financial milestones. The stock's true value will be earned on the factory floor and in the balance sheet, not just on the trading screen. This disconnect between market expectation and operational reality remains the central theme for Plug Power.